Hello, and welcome to our third installment of the 8-Minute Update. I'm Chris Walker, Vice President of Freedom One's Investment Research Department, and I'm pleased to also have with me Roberta Angelo, Vice President of the Client Relations here at Freedom One. These 8-minute updates are to provide you insight into how Freedom One is working to best meet your investment goals. Our continuing theme of Protect, Prepare, and Recovery is in place. Today's topic, Seeking Signs of Recovery. As we've discussed in prior 8-minute updates, Freedom One's 2009 two-step process of protecting your investment principal while preparing for an upcoming economic recovery is in place. Our first step was to decrease the overall equity allocation in the portfolios. As you can see here, our most aggressive portfolio only had 65% in stocks. We've also gone through and utilized more conservative, higher quality mutual funds in the 65% in stocks. So this is a very conservative portfolio.
What do you mean by higher quality mutual funds?
What I mean by that is that there are funds that will seek to have stocks that are a little more stable. Rather than having very aggressive stocks, we're looking for the higher quality companies in these portfolios. That provides an investor a little less volatility and a little more strength.
Okay, well that makes sense. If we're in protect mode, we would start off the year a little bit more conservatively than normal. So I'm anxious to know, and I know from talking to clients, we're all anxious to know, how did this strategy play out for the first quarter?
The first quarter was a very difficult one. The stock market was down over 11%. I'm very pleased to say that although in a very difficult market, our portfolios performed very well. Our aggressive portfolios were down 6.78%, all the way down to our more conservative income portfolios of down less than 1.5%. I'm certainly not thrilled to have negative performance, but in that very, very difficult environment, our portfolios held up very well.
Yeah, it definitely looks like the strategy is doing what it's supposed to do and protect us. So what's next?
What's next is we're in this prepare mode. What we've done is last December we identified 12 different economic indicators that were supposed to help us foretell when it was an appropriate time for the economy to start moving forward and to reallocate the portfolios. Last December when we identified these, all 12 of them were negative. As of April 2nd, our most recent investment committee meeting, 5 of these continued to be negative, 1 actually turned positive, and 6 of them turned neutral. So we've seen a substantial improvement in these indicators. Of the 6 that are neutral, 4 of them are actually showing continued signs of improvement.
Okay, so that looks like improvements. That's good news, but I'm not sure I exactly know what you mean. What is an economic indicator? Maybe you could give me some examples.
Certainly. An economic indicator really is it's a statistic that's supplied either by the government or by a private corporation, which gives you a little bit of insight into what's going on in different parts of the economy. So, for example, here the slide here talks about housing. The National Association of Realtors goes through and keeps track of the housing sales in different parts of the housing market. One of the statistics they keep is called pending home sales. That's really where they will look to see homes where there's been contracts to purchase them even though they haven't closed. We've seen a substantial increase. It's gone up 2.1% in the last month. That may not sound like a lot, but that's showing that the housing market is starting to improve. Now, whether those pending sales were because of low prices caused by short sales or foreclosures might be disappointing to all of us, but it is showing signs of improvement. Another one that we certainly have heard a lot of recently has been the stock market. Believe it or not, last month the stock market increased over 8.75%, and from its low actually is up over 20%. So the stock market, that would be another indicator that we would use to see if the economy is starting to show signs of improvement. Another economic indicator that we keep track of, supplied by the Institute for Supply Management. What this does is this keeps track of the manufacturing output by factories. And you can see from this blue line that from the beginning of 2007 all the way to the end of 2009, it should come to no surprise to any of us that factories were decreasing the amount that they were of their outputs. You can actually see that new orders have started to increase. So for the first quarter of 2009, you can see that tail has started to move up from below 30 up to above 40. That's showing additional signs of recovery. Another one that's very close to all of our hearts is the employment rates. Now, unemployment came out at 8.5%, and that's very disappointing, and it's probably going to go higher. Unemployment is really a lagging indicator. What we're trying to review, though, is planned job cuts. For example, last December and January, you can remember, it seemed like every day we were hearing about some major corporation that wanted to have another 10 or 20,000 people it was going to lay off. You haven't heard those lately, so planned job cuts have actually started to decrease. So what we mean by economic indicators can really be simple things that we're all familiar with, whether that be home sales or the stock market or factory output or employment. So I think those are all things that we can recognize, and what an economic indicator is a more sophisticated way to monitor those things.
Well, that's really good news. That's kind of exciting. New factory orders up, stock market rally in March, slowing of job cuts. That has me wondering if it's time to get back into the stock market. Have we seen the bottom?
I think you're probably ahead of yourself a little bit. Our outlook right now is, yes, things are definitely improving. And it's probably better said that they've stopped getting worse. The deterioration in the economy has slowed down. But we need to see this sustain itself. Right now, we're not really seeing sustainable changes. We hope that all of these indicators that will, rather than just having a few of them showing positive, we want to see a majority of them showing positive. And that's probably not going to happen until later in 2009, possibly early 2010. We're certainly going to be vigilant and keep on top of these things, and we hope to be surprised. There'd be nobody more thrilled than I would if the economy turned faster than we anticipated. But I think it might be, we still have to remain a bit more conservative right now.
Okay, so it sounds like I need to be a little bit more patient. We're still clearly in prepare mode, but I'd like to know about what to expect going forward. Once we start to see more sustainable changes, how will Freedom One adjust the portfolios to make sure that investors like me participate in the recovery?
That's definitely what we want to do. When the stock market starts to move up, we want to be a part of that. We're going to do two things. One is we're going to increase overall stock allocation. Right now, we are very conservative. We will start to go through and allocate more money towards stock mutual funds. The other thing that we're going to do is, as you asked me earlier, is what are more conservative type stocks? What we start to do is to buy less conservative type stocks. That means maybe possibly some into small cap or mid cap type stocks, or even the international market. So that's really that's step 2 of our recovery, and we hope that will start hopefully by the end of this year.
Well, I'm an aggressive investor, and I know in my portfolio I have some international and I have some small caps. So what do you mean by that?
What I mean by that is that we will increase those exposures. We always want to go through and to have a certain amount allocated to those different asset classes. But there are times in the market where we want to be more conservative, like we are now, and hopefully by the end of this year we want to be more aggressive to where, yes, you own some of those asset classes, but we'll want to increase that allocation.
Okay, that makes sense. I want to thank you, Chris. I really appreciated you including me in this. It's been very helpful, and I'm really glad to hear that the portfolios have performed so well in the first quarter. Can you tell me, when can we expect the next 8-minute update?
Roberta, thank you for being part of this. Our next 8-minute update is going to be on April 23rd, and that'll continue along the theme of protect, prepare, and recover. And once again, as you did last time, if you could please fill out the attached survey, which should give us ideas on future topics for the next 8-minute update. Thank you again.